when the ground beneath you shifts. My name is Kevin Price, and I want you to listen very carefully to what I am about to say, because this is not a video I made to get views. This is a video I made because I genuinely believe that what is happening in the financial world right now is something that most ordinary people are not prepared for. And the cost of being unprepared when this particular storm fully arrives is not something you can easily recover from. Let me start with a moment from my own life. A few years into my financial journey, I had built what felt like a solid foundation. I had a portfolio that was growing. I had income coming in. I had done what every conventional financial voice had told me to do. Stay invested in the market. Trust the system. Keep your money working for you. And for a long time, that advice served me reasonably well. But then I started noticing something that made me deeply uncomfortable. It was not one single event. It was a pattern. A slow, quiet, relentless pattern of the dollar buying less and less of everything around me. My grocery bill was higher. My utility costs were higher. The cost of repairs, of services, of everyday necessities, all of it was creeping upward. And yet, the official narrative was calm. The economy is fine. The system is stable. Trust the process. I remember sitting down one evening and doing something very simple. I compared what my portfolio was worth in dollar terms to what those same dollars could actually purchase in the real world. And what I found unsettled me deeply. The numbers were going up, but the real value, the actual purchasing power of what I had accumulated, was not keeping pace. I was winning the game on paper and quietly losing it in reality. That evening changed the way I think about money, about markets, and about the dollar itself. And everything I am going to share with you today flows directly from the lessons I learned by asking the questions that most investors are never taught to ask. So let us begin. Let us talk about what the title of this video actually means, because I chose those words deliberately. Dollar collapse. Stocks in serious trouble. And I want to be precise about what I mean, because precision matters when we are talking about your financial future. When I say dollar collapse, I am not talking about a Hollywood movie scenario where the currency becomes worthless overnight and society breaks down. That kind of language belongs to people who are trying to frighten you into buying something. What I am talking about is something far more insidious and far more likely. I am talking about a sustained, structural decline in the purchasing power of the dollar. A slow erosion that happens not in a single dramatic moment, but over months and years, quietly diminishing the real value of everything you have saved, everything you have invested, and everything you are planning to live on in the future. This process is already underway. It has been underway for decades. But there are specific conditions present right now, in this current environment, that suggest the pace of that erosion is about to accelerate significantly. And that acceleration, when it hits a stock market that is priced for perfection, creates a combination of risks that I believe every serious investor needs to understand before it is too late to respond. Now let me explain why stocks specifically are in trouble, because this is where I think a lot of people have a fundamental misunderstanding. Most investors have been told, and genuinely believe, that stocks are a hedge against inflation. That when the dollar loses value, stocks go up to compensate. And historically, there is some truth to that idea. Companies own real assets. They generate real revenues. And in an inflationary environment, those revenues eventually rise with prices. But here is what that theory leaves out. It only works cleanly when inflation is moderate, when interest rates are managed carefully, and when corporate earnings are genuinely growing in real terms. When inflation becomes severe, when the dollar weakens rapidly, and when the cost of everything from raw materials to labor to borrowing rises faster than companies can pass those costs on to consumers, the earnings picture deteriorates sharply. And a stock market that was priced on the assumption of strong, stable earnings suddenly finds itself without the foundation it was standing on. That is the scenario I am describing when I say stocks are in serious trouble. Not a routine market correction, not a temporary dip that bounces back in a few months. I am talking about the kind of prolonged, structural repricing that happens when the currency supporting an entire financial system begins to lose credibility in a meaningful way. I want to spend a moment on that word, credibility, because ultimately every currency in the world today, including the dollar, is backed by exactly one thing: trust. The belief that the issuing government and its central bank are managing the currency responsibly. That the money you hold today will be worth approximately the same amount in real terms tomorrow, next month, next year. The moment that trust begins to fracture, the moment large numbers of people and institutions start questioning whether holding dollars is a sensible long-term decision, the dynamics change very quickly. And the evidence that this fracturing is beginning to happen is not hidden. It is visible in the data, in the behavior of foreign governments, in the flow of money into alternative assets, and in the purchasing decisions of some of the most sophisticated financial institutions in the world. We are going to go through all of that evidence in the parts that follow. But for this first part, I want you to sit with something. A single, foundational idea that will frame everything else we discuss. Your financial security is not measured in dollars. It is measured in what those dollars can actually buy. And any strategy, any portfolio, any financial plan that does not account for the possibility that the dollar's purchasing power may decline significantly over the coming years is a plan built on an assumption that the current moment may be in the process of proving wrong. This is not doom and gloom. This is not a reason to panic. This is a reason to think carefully, act deliberately, and position yourself with the kind of clarity and discipline that separates the investors who navigate these transitions successfully from the ones who look back years later wondering what happened to everything they built. In the parts that follow, we are going to go deep. We are going to look at the mechanics of how currency debasement actually works and why the current level of government debt makes it nearly inevitable. We are going to examine the stock market's current valuation and why it is particularly vulnerable in a weak dollar environment. We are going to talk about what history tells us about how these transitions unfold and what the average investor experiences when they are not prepared. We are going to discuss the specific assets and strategies that have historically preserved and grown wealth during dollar weakness cycles. And we are going to build a practical, grounded framework for how you can think about your own financial position in light of everything we cover. This is going to be a long conversation, an honest one, without shortcuts, without promises, and without the kind of artificial urgency that tricks people into making decisions they later regret. Stay with me, because what comes next is the part that most financial channels are either not willing or not equipped to tell you. When the foundation cracks. My name is Kevin Price. Stop what you are doing, because what is unfolding in the financial system right now is not a routine cycle. It is a structural shift, and the people who do not see it coming will feel it the hardest. A few years into my own financial journey, I had done everything by the book. Diversified portfolio, steady contributions, long-term mindset. On paper, everything looked fine. But I started noticing something quietly disturbing. Everything around me was costing more. Not dramatically, just consistently. Month after month, the same dollar was buying slightly less than it did before. And when I sat down and measured my portfolio not in dollar terms, but in real purchasing power, the picture was far less comfortable than the numbers suggested. That realization changed everything about how I think about money, and it is the foundation of everything I am going to share with you today. When I say dollar collapse, I am not describing an overnight catastrophe. I am describing something far more dangerous precisely because it is slow. A sustained, structural erosion of the dollar's purchasing power that happens quietly, consistently, and without dramatic headlines until it has already done serious damage to everything you have saved and invested. This process is already happening, but specific conditions exist right now that suggest the pace is about to accelerate. And when that acceleration meets a stock market priced for perfection, the result is what I am calling serious trouble. Most investors believe stocks protect them from inflation, and in moderate, controlled conditions, that is partially true. But when inflation becomes severe and the dollar weakens rapidly, corporate costs rise faster than revenues, borrowing becomes expensive, and the earnings assumptions holding up stock valuations begin to collapse. That is not a hedge. That is exposure wearing the mask of protection. Every currency today is backed by one thing only: trust. And the evidence that trust in the dollar is beginning to fracture is no longer hidden. It is visible in debt levels, in foreign government behavior, in institutional money flows, and in the accelerating movement toward alternative stores of value worldwide. Your financial security is not measured in dollars. It is measured in what those dollars can actually buy. Any plan that ignores the possibility of serious dollar weakness is a plan with a hole in it. In the parts ahead, we cover the mechanics of currency debasement, why the stock market is especially vulnerable right now, what history tells us about these transitions, and what you can actually do about it. Dollar collapse warning. Stocks in serious trouble. Part 3 of 5. What history tells us and what most investors refuse to hear. History is the most honest financial advisor you will ever have. It does not have an agenda. It does not have a product to sell you. It simply shows you what happened, how it happened, and what the people who survived it did differently from the people who did not. And when you study the history of currency debasement, one pattern repeats itself with uncomfortable consistency. Every time a major government has spent beyond its means for long enough, every time the debt has grown too large to be repaid honestly, the path of least resistance has always been the same. Inflate the currency. Make the debt cheaper to repay by making the money worth less. And let the population absorb the cost quietly through the erosion of their purchasing power rather than through the visible, politically painful act of raising taxes or cutting spending. This is not a conspiracy. It is arithmetic, and it has played out in different countries, in different centuries, in different economic systems, with the same basic outcome every single time. Now, the critical question is not whether this pattern applies to the current moment. The debt levels, the deficit spending, and the behavior of central banks over the past decade make that connection difficult to argue against seriously. The critical question is what happens to the people who are holding conventional assets, particularly stocks and cash, when this transition accelerates. And here is what history shows us very clearly. In the early stages of a currency debasement cycle, stocks often appear to hold up. In nominal terms, the numbers may even rise. Because as the currency weakens, it takes more units of that currency to buy the same asset. So the stock market can look like it is performing, when in reality it is simply reflecting the declining value of the currency it is priced in. This is one of the most dangerous illusions in investing. Nominal gains masking real losses. The investors who understood this distinction, the ones who measured their wealth in real purchasing power rather than in the number of currency units they held, were the ones who made the right moves early. They did not wait for the headlines. They did not wait for official confirmation. They read the structural signals, and they acted before the crowd recognized what was happening. The investors who waited for certainty, who needed the mainstream to validate what the data was already telling them, consistently arrived too late. They bought protection at peak prices. They sold conventional assets at depressed prices. And they experienced the full force of the transition rather than navigating around it. I want to be direct with you about something. There is a very human tendency to look at a warning like this and think, surely it will not be that serious this time. Surely the system will find a way to manage it. And that thought is not unreasonable. Systems do adapt. Governments do intervene. Central banks do have tools. But those tools all come with costs. And the primary cost of every tool available to a government facing a currency crisis is paid by the holders of that currency and the assets priced in it. Every intervention, every stimulus, every debt monetization program transfers value away from savers and conventional investors and toward hard assets, real resources, and anything that holds its value independent of government policy. Understanding that transfer mechanism is not pessimism, it is literacy. Financial literacy of the kind that allows you to position yourself on the right side of what history strongly suggests is coming. There is one more thing history teaches us that I want you to carry into the next part of this conversation. The people who navigated these transitions best were never the ones who predicted the exact timing. Timing a currency crisis is nearly impossible. What they did instead was recognize the structural conditions, accept that the direction was clear even if the timeline was not, and build positions that would benefit from the transition regardless of whether it took 1 year or 5. Patience combined with preparation. That is the historical formula. Not panic, not paralysis. Preparation. What you can actually do about it. Everything we have covered so far has been diagnosis. Now it is time for the prescription. Because information without a practical path forward is just anxiety with extra steps. And that is not what I want to leave you with. Let me be clear about something before we go any further. There is no single perfect answer to what I am about to describe. There is no one asset, no one strategy, no one allocation that works identically for every person in every financial situation. What I am going to give you is a framework, a way of thinking about your financial position that allows you to make decisions that are grounded in reality, rather than in either blind optimism or paralyzing fear. The first thing you need to do is something most investors have never actually done. Measure your wealth in real terms, not in dollars, not in the number on your brokerage statement, but in genuine purchasing power. Ask yourself honestly, if inflation continues at an elevated pace for the next 5 to 7 years, what is the real value of what I currently hold going to look like? Which of my assets will maintain or grow their purchasing power? And which ones are quietly being eroded while the nominal numbers stay flat or rise modestly? This single exercise, done honestly, will tell you more about the true health of your financial position than any portfolio report your broker has ever sent you. The second thing I want you to think about is the concept of currency diversification. Most people think of diversification only in terms of asset classes, stocks, bonds, real estate. But in an environment where the dollar itself is under structural pressure, genuine diversification means having a portion of your wealth in assets that are not denominated in dollars and not dependent on dollar stability for their value. This does not mean moving everything offshore or abandoning the financial system entirely. It means deliberately allocating a meaningful portion of your portfolio to assets whose value is determined by forces other than the decisions of a single central bank. Hard assets, commodities, precious metals, productive real assets that generate real income regardless of what any currency does. These are not exotic instruments. They are the oldest forms of wealth preservation in human history, and they become relevant again every single time a currency cycle turns. The third area I want to address is the stock market specifically. Because I am not telling you to abandon stocks entirely, that would be an oversimplification that could cause real harm. What I am telling you is to be very selective and very honest about what you own and why. Not all stocks are equally vulnerable in a dollar weakness environment. Companies that own real assets, that generate revenues in multiple currencies, that provide essential goods or services with genuine pricing power, that carry low debt and strong cash flows, these businesses can navigate inflationary environments with far more resilience than highly leveraged, growth-dependent companies whose valuations rest entirely on cheap borrowing and optimistic future earnings projections. The difference between those two categories of stocks in a serious dollar weakness cycle can be enormous. And most retail investors have no idea which category the majority of their holdings fall into. Taking the time to understand what you actually own, what each company's real exposure is to inflation, to rising rates, to dollar weakness, is not optional in this environment. It is essential. The fourth thing I want to address is debt, your personal debt. Because here is something that many people do not fully appreciate. In a genuine inflationary environment, fixed-rate debt actually becomes less burdensome in real terms over time. You borrowed dollars at a certain value, and you repay them with dollars that are worth less. That dynamic can work in your favor if the debt is structured wisely and the asset it financed is a real, productive one. But variable rate debt, consumer debt, debt that carries no corresponding real asset, that becomes a trap in an environment where rates rise to combat inflation. If you carry significant variable rate obligations, reducing that exposure now, before the pressure intensifies, is one of the most protective financial moves available to you. And finally, I want to talk about the most overlooked asset in any financial plan: your own knowledge. The investors who navigate difficult transitions successfully are almost never the ones with the most money. They are the ones with the deepest understanding, the ones who took the time, in moments exactly like this one, to genuinely educate themselves about what was happening in the broader financial system and what it meant for their specific situation. That understanding cannot be taken from you by inflation. It cannot be eroded by currency weakness. It compounds silently, and it pays dividends in every financial decision you make for the rest of your life. You are building that understanding right now, in this conversation, and that matters more than you might realize. The final warning, and the decision that defines your financial future. We have traveled a long road together in this video. We started with the quiet, uncomfortable reality of purchasing power erosion. We walked through the mechanics of how currency debasement actually works. We let history speak honestly about what these cycles look like and who they hurt the most. And we built a practical framework for how to think about protecting and positioning what you have worked so hard to build. Now I want to close with something that I believe is the most important thing I can say. Not a strategy, not a data point, a warning about human nature itself. Because in my experience, the greatest financial threat most people face in a moment like this is not the dollar. It is not the stock market. It is not inflation. It is the very predictable, very human response to uncomfortable information. And that response has a name. It is called normality bias. It is the deeply ingrained tendency of the human mind to assume that the future will largely resemble the past, that the systems we have lived within our entire lives will continue to function the way they always have, that the warnings, however well-reasoned, will ultimately amount to nothing, because somehow, some way, things will work themselves out. Normality bias has cost ordinary investors more money throughout history than any market crash, any currency crisis, or any financial scandal ever has. Because it does not announce itself. It does not feel like a mistake in the moment. It feels like calm. It feels like patience. It feels like not overreacting. And by the time the evidence becomes undeniable, by the time the mainstream catches up to what the structural signals were saying months or years earlier, the opportunity to act wisely has already passed. I am not asking you to abandon your critical thinking. I am not asking you to accept everything I have said today without question. Healthy skepticism is a sign of financial intelligence, and I respect it. What I am asking you to do is examine your own response to this information honestly. Ask yourself whether the resistance you might be feeling right now is rooted in genuine disagreement with the evidence, or whether it is rooted in the discomfort of having to change something, of having to act, of having to think differently about money than you have been taught to think your entire life. Because those are two very different kinds of resistance, and only one of them is protecting you. Here is my final warning, stated as plainly and as directly as I know how. The conditions that are currently present in the dollar, in the debt markets, in the stock market's valuation, and in the behavior of the global financial system do not resolve themselves gently. They have never resolved themselves gently throughout history. They resolve through a repricing, a forced, uncomfortable, and often rapid adjustment that redistributes wealth from those who were not paying attention to those who were. That repricing may not happen this month. It may not happen this year. But the structural forces driving it are not going away. They are not being addressed. They are, in fact, being compounded by every additional dollar of debt, every additional intervention, every additional delay of the honest reckoning that the system has been postponing for years. The window to prepare is open right now. Not because I am telling you it is, but because the data, the history, and the structural reality of this moment are all pointing in the same direction. And windows like this one do not stay open indefinitely. So here is what I want you to do after this video ends. Do not just watch it and move on. Sit with it. Go back through the framework we built together. Look honestly at your own financial position. Measure your real purchasing power. Examine what you own and why. Identify the gaps between where you are and where you need to be, given everything we have discussed. And then, take one deliberate, informed step in the right direction. Not a panicked overhaul, not a dramatic repositioning driven by fear. One deliberate, informed step, and then another, and then another. That is how financial resilience is actually built, not in a single dramatic moment of action, but in a series of quiet, disciplined decisions made while others are still convincing themselves that nothing needs to change. I am Kevin Price, and I want to say something to you directly before we close. The fact that you are here, that you watched this entire video, that you are willing to sit with uncomfortable ideas and think seriously about your financial future, that already puts you ahead of the majority. Most people will not do this. Most people will scroll past the warning, return to the comfortable narrative, and hope that things work out. You chose differently today. Honor that choice by doing something with what you now know. Your future self is watching the decisions you make right now. Make them worthy of the life you are trying to build. If this video brought you genuine value today, please take a moment and hit that like button. It is the simplest way to tell me that this kind of honest, in-depth financial conversation is worth continuing. If you are not yet subscribed to this channel, now is the time. Every video I make is built on the same foundation as this one. No hype, no shortcuts, no empty promises. Just serious thinking for serious investors who want to protect and grow what they have built. And if something in this video sparked a question, a concern, or a thought you want to explore further, drop it in the comments below. I read every single one. Your question might be the starting point for the next conversation we have together. This is Kevin Price. Stay informed, stay disciplined, and stay ahead.